Hey, it's Sasha Evdokov. It is July 30th, 2015, and welcome to the Rapid Recap. This week in the Rapid Recap, we're going to be covering the lesson of extreme stock market trading at the end and the beginning of the month. So that's the key point for the lesson for this week. And if you haven't joined us before on the Rapid Recap, we usually do a discussion about some stocks, some common stocks, and then we'll go in detail with a little bit of a lesson. So I apologize for not being available last week. We were down in Florida just enjoying the water, and then where I was actually at the time, we were visiting a friend, and by the time things were said and done, the internet wasn't working as great as I had hoped, so we didn't do the Rapid Recap, but usually I try to do about 43 recaps per year out of the 52 weeks in a year, so I really try and strive to do them almost every single week, and there's a few with the vacation days that I try and take that I don't do them. So this week, just be prepared. We're going to have a great recap. I'll do a few stocks and then do a lesson about trading at the end of the month, something that I haven't covered much in the past. So be prepared. Let's get started and let's get going. So first things first, I do want to let you know that I did post some critical charts for those of you that are members today as well. There's 13 charts. And one of the first ones, the free chart, by the way, even if you're not a member, you can always get a free chart. The free chart is cake. And you can see here, I even put the previous chart here, so that way you can see what we were talking about in the previous critical chart. We talked about this stock potentially coming back to 55 and bouncing, and this stock did exactly what we projected, exactly what we were looking at. So notice that stock currently pulling back and then bounced. So take a look at those critical charts if you're a member, and just go ahead and sign in, and they're posted, so there's some more charts in there for you. And if you want to get notified automatically when they are posted, just connect with me on Twitter, and the website automatically feeds to Twitter. All right, with that being said, let's start out right there. Actually, let's take a look at cake. So I took a look at this stock for quite a while. I've been watching it for some time just because of the energy it's been building. So I noticed that it was hitting a few critical areas on this stock, and one of those was this resistance point right here. Now, your next entry point really would have been right here, but unfortunately, the downside behind that was, if you notice, it gapped up a little bit. When stocks gap up, sometimes I don't like to chase. I may nibble. By nibble, I'm talking about I may put on a very light position here at the top once they kind of get moving. So I may put a light position here because they have a tendency to pull back. If it's strong enough, they'll retest this and bounce, okay? So that's where you would enter your full position, okay, once you start seeing the bounce. And that's exactly what we discussed in the critical chart. So you had a play-by-play on that one, that the stock really was showing you its hand right here, building energy, exploding there to the upside. Let's see, was it that day that we had volume? No, the next day. So we had volume right here on the next day. But you can see that even the day before, we had a very powerful volume bar right here, where most of it was just at this level, and then we hit that bar, and right here this stock started to push. It didn't break it yet, it just started to push on this level, and then finally we broke out, and we broke out on massive volume. And when you do that, you always just be prepared for a slight pullback, especially if you gap up. This happens on Amazon, it happens on Google, and we'll talk about those. But then you're just patient, waiting for that setup right there. Boom, stock powering higher, looks good for higher prices. And if you got in it right there where we talked about it, then just continue to peel some off into strength, especially as we hit these $58 levels. So just take a few shares off for profit. But you can see nice clean line, nice break, solid. Let's just take a look at the Dow Jones and the S&P. You can see here we had a little sell-off, and then we're popping again. I'm not buying into this little pop. It's light. I don't see the strength at this point. If you look at the S&P here, we're still moving sideways. When you really look at it and you really boil it down, we're not really power and higher because still from January, we're still kind of moving sideways. So it's a stock picker's market. And you can see what's been happening is that the last 3 times we've reached these levels, basically 1, 2, 3, we pull back. Okay, now the times that it bounced was coming back to this level. So you can see it came back here, it bounced. This time was a little bit different. We bounced here off of that 200-day moving average. But really, I mean, I'm not seeing the full strength yet, and I'm not getting in till I see it clearing this line. And I'm patient. I'm waiting for the opportunities. And that's what I do. Same thing with stocks like Apple. So looking at this stock and looking at Apple right here, you can see that this stock, we've covered it a handful of times, many times. That right here, this was the initial sell-off point, okay? The next point right here was earnings. This one as well sold off. Then we had another one. Now again, that's why I'm waiting for this line to clear if I'm looking long. But now it's looking actually more of a setup for a short. Okay, so really, if you're looking at the bounces, where is it holding up? It's holding up right here. It's holding up right here. And now we're pushing down on it. Now we did come back right here and the stock bounced. But usually these bounces are short-lived. It's oftentimes these shorts taking profits because they knew it was going to do this. So the stock came back up right here, rejected it, couldn't even fill that gap fully, came back down, and now it's pushing lower. So when you look at these stocks, it doesn't matter what it is, don't fall in love with them. It's pushing down. It's pushing down. Now, you want to be extra careful on this stock, especially these stocks that people love. They love them. And when they love them, what happens is they drop, but then they snap back. They snap back because people love them and they want to get in them at a cheaper price. So be very careful that if you're watching this, you have a tight stop. A safer bet would be the 118, with a couple dollars of wiggle room, $4 or $5 wiggle room. If you want to nibble, once it breaks right here with nice volume picking up, at the 121, 25 level, right around there, that might be a good area for a short. But you're always watching this because why? What happens? What happens over here? We draw that line across. Look how that worked out perfectly. Okay, so some of these things that I don't always show you guys. I don't want to overcomplicate the chart, but look at how this swing point right here comes into this swing point. So you're always watching different levels that the stock can come into and how it's going to be. The same thing that we talked about before on Apple, that we have an A to B point, B to C, and C to D point. Those of you that studied the green stock trading foundation course or even the blue course, technical analysis course, know about these ABCD patterns. So I'm still in the same camp with this one. With Apple, I'm watching these swing lows. It's pressing on it. And, and definitely if it breaks lower, we're definitely going to be going short. Next stock I want to cover is Twitter. Same thing on this one. I've been looking at this one for a little while. We have this line right here that it broke. I mean, really, we were looking at this short way back here. Ideally, we were watching this for months on the short. So here was the upward trend line, little triangle pattern, resistance, rejection right there in April. So when we rejected here, there was a huge sell-off. Okay, then you create another support line right here. That stock was basing. So if we zoom back in, that stock was basing right here and building cause. And what was it building cause for? Pushing lower, kept pushing. Okay, so now it broke lower again. Can we snap back and reattempt the $34 level? Absolutely. But you still have this critical swing point and line at the $30 level. But if this stock breaks this $30 level, then all bets are off. You can see it going much lower. You can see lower prices. And I can share with you a handful of stocks. One I used to trade. I used to love to trade this one back when I was a teenager. Back in the day, when you look at the monthly, over here we traded $30 and $40 and so forth. And this stock has been at the dollar level since 2009. So just because it's Twitter doesn't mean it can't be a cheap stock. Okay, so always be mindful. Look at Groupon. You know how popular that website is, the Groupon website. All the people posting all this stuff on the Groupons and the discounts and everything, and sharing it on. Huge website, huge company, massive traffic. But the stock, look at the stock. It's since 2013, it's been at $3-4, $3-4. So can it happen on Twitter? Absolutely, absolutely. Will it happen? I don't know. Time will tell. But what you can do is manage your risk, manage your money, manage your portfolio, manage what's happening in the marketplace, and trade it accordingly. This stock would be a very nice short. If you're not short on it already, it would be a nice short to get into right around the $29.52, 55 cents, right around there, $29. And you can obviously on volume's picking up. You can even nibble some now. Just be prepared for a light little bounce, maybe potentially to test the 34. Because if it gets above this $34 level, you can see it go back higher and play around in that region and level. Because again, it's another favorite. Those managers, they love pushing these stocks. They love holding these stocks. And again, we'll talk about that here in a second. They love holding these big boy companies because it makes them look good. Okay, it makes them look spiffy, nice suit. Nice, good-looking, stock to show the investors what we got, right? So let's take a look at Amazon. Okay, this one gapped up. Okay, gapped up, and then again pulling back, just like some of the other ones we talked about. When they gap up, they pull back, just like the cake, just like some of the other stocks. They'll pull back and retest levels. Sometimes they don't go back and fill the gap all the way. It just depends how much strength. But this one, if we take it out to the weekly, you can see that this stock's been building a nice stair-step pattern. So right now it's overextended. I wouldn't chase it. But if we have pullback and the stock fills the gap and then bounces, just like we had with cake, stock gaps up. Okay, even though this one's a cheaper stock, the principle is the same. Stock gaps up, pulls back, and then bounces. Okay, you watch the same exact thing with Amazon. Stock gaps up, pulls back, wait for a bigger pullback. This is a light pullback, or you can nibble, wait for a larger pullback, and then if you see it bouncing, you can enter the stock. Okay, but right now we're still trying to consolidate from that that huge gap up. So always be mindful where you're at. Okay, stocks build, power higher, build, power higher. It takes time. It takes energy to build these patterns and momentum, because they just don't go straight up. They don't go up forever, because then nobody would be selling it. They'd just be holding on to stocks and nobody would be profiting. We'd just be holding on to stocks, buying stocks, and not doing anything with them, because that's the act of trading. All right, let's take a look at Google. Google, same concept. Look at this consolidation pattern, just like an apple consolidating pattern. There it is. It's a consolidating pattern. We gap up, we pull back, watch this level for that pullback. And if it starts bouncing, right now it's not ready. It got a few green bars, but it's not ready. We gapped up extremely large. That's why you always don't chase those gap ups. Most people sell into earnings. Wait for the pullback, and you can start to nibble. If you start nibbling here, you got to give it a $35 stop or so, because that stock can pull back to $607, $600, and nothing be wrong with the stock. It can still pull back 30, 40 points, and that stock would still be healthy. All right, and the last one I want to cover, we're just covering the big companies right now. The last one I want to cover is a Netflix. Same kind of pattern, same kind of things happening. We got stair-step action, stair-step patterns. You can see that this stock, what it's been doing, slowly stair-stepping. Okay, long-term picture, that's what's happening. If you look into the more intermediate and the trading, look at what happened. Gapped up, pull back, powering higher again. We're retesting these highs right there. Stocks holding up. Volume now coming in. The day's not over yet. It's actually 3:42 p.m. here on the East Coast, and we already are pushing 12.7 million shares, whereas the previous day was 6.7, and some of the sell-off days were 8.3 million. So we're nearly doing double that, almost double. We'll see how the end of the day turns out, but really holding up pretty well here as well. So always watching how stocks move, and the better you understand how they move, the better the advantage you have. All right, so I want to cover this little lesson in terms of talking about the end of the day trading, beginning of the month, end of the month, and so forth. We talked about some of the big companies today, and that's the reason why I wanted to cover the big companies today, was because it implements within this lesson. Now, for those of you that are in the critical charts, we have some other companies in the critical charts right here that aren't as big of companies. There's some other companies listed in there, so make sure you check those out if you're if you want to see some of the other stocks that are in there, because it'll give you a variety of the stocks for this week. But in terms of looking at who moves the markets, it is these big companies. It's the Apples, the Twitters, the Amazons, the Googles, the Netflix. And I wanted to cover them to kind of tell you a little story, some insight behind why these big companies are popular, or why the hedge fund managers like trading them. Really, in the long scheme of things, you have to remember that most of the market, most of the things that are being created, moving, that changes the market directions, is these hedge funds, is these money managers. It's all these brokers that really move these markets, because they have a lot of capital to play with. They have some of them hundreds of thousands of people, some of them a lot more, and they play with other people's money. And when they do the reports at the end of the month, they're going to show something like this. So the money that Mr. Smith has for June, to keep things simple, let's just say $1,000, okay? In July, he may have, let's say, $1,200. Now, along with each one of these months, there's also usually a breakdown. So what happens is there's a breakdown of, let's say, they owned Apple, they owned Google, they owned Netflix, they owned Twitter, okay? Maybe they owned Amazon. And his $1,000, he has a slight little piece in each one of these companies. Now, in July, it's going to look maybe something exactly the same. It might be, again, you might have maybe one stock that might change, or one or two. Maybe you have ExxonMobil or something like that. So, but it's popular companies that the person can relate to. And that is because they need to print out a statement of what's happening, what's going on. Now, the thing that they don't have to do is disclose what's going on and what's happening mid-month. So if we backtrack this and we say, okay, this is July 31st, okay, what's happening in July 1st, July 15th, okay, so what goes on between these time frames is slightly something different. Okay, so what may happen, and let's just add another date, so July 25th. What may happen is on July 1st, these investors may get into, these hedge fund managers, they rotate positions, because that's kind of what happens on this June 30th, 2015, July 1st, and so forth. They do a lot of rotations. So what's going on is on July 1st, they get into some positions that maybe you don't even know about. So let's just say JEC, AMD. Let's just talk about some companies that maybe aren't even listed. Let's just put a few tickers on there that are just make no sense. Okay, so we may have some positions on these risky plays, and then maybe we'll have like an Apple and Amazon, and one or two other ones. But most of the portfolio might be more risky plays. Okay, that's July 1st. By the time we get to July 15th, you still may have somewhat of a similar portfolio. Okay, you might have a similar portfolio, and they start evaluating what is it that's losing money and making money. Okay, so if things are making money, they'll keep it, obviously, to show their investors. If things are losing money, they may, let's just say, they'll eliminate one. Okay, so we'll eliminate one. Now, if things are really bad, let's just say things aren't working out really well in their favor, or they want to show a little bit of strength, the investor may not know who AMD is or who OOO or PPP is. They know Amazon, they know Apple, but they don't know who these other companies are. But they can relate to Amazon. They can relate to Apple. They have an emotional connection to them. So what happens in July 25th is they start rotating the position. They may get rid of these positions and they may put in a Google. They may get rid of this position, and then they may put in something else, like, let's say, a Twitter or whatever. So they start dressing things up. That way, by the time we hit, June, July, the end of the month, by the time we hit it, everything looks very pretty, very nice. It looks dressed up, and it's called window dressing. And that's really what happens. So even if for that month, this guy, Mr. Smith, lost, let's say, $300, it doesn't look very bad because, he owns, let's say, by the end of the month, some of the best companies out there, some of the best companies that you can own. So that's really what they're doing at the end of the month. And that's why markets towards the last few days of the month behave the way that they do. And what happens there on those first few days of the month, again, August 1st, or the first trading day. I'm not saying August 1st would be the trading day because years change. But let's say in the first few days of August, what happens is, again, they may buy something more speculative. Okay, they may buy something a little more risky or whatever it is. And then after that, they may put in or hold some of their other positions just to make things look good. But they rotate things out and they adjust their positions. Now, really, the whole point of it is because people are giving them money. They need to send reports. What's going on with their money every single month? How is it doing? What positions are they in? And, different brokerage firms, companies, investor, people that manage your capital, if you give it to them, they send you different types of reports. But really, this is what it comes down to. And they have to show their investors or the people they're dealing business with, somebody that just gave them $500,000 or $1 million, they want that portfolio, they want it to just look good, at least look good, even if it's not making money. It's got to look at least good on paper, regardless of how much it's making. Now, it's going to look even better if they're making money, but if they're not, they just want to dress it up. And again, this is called window dressing, and it usually happens the last few days of the month. Now, there's a study there done as well. Here it is actually by Fidelity, and I just stumbled across this, monthly trading patterns, and you can read the article for yourself, but it's called Monthly Trading Patterns, Human Behavior Shapes Market Activity. And I'm not promoting the article, I just want you to see this chart just as a reference point. What happens on the performance of each day of the month based on the number of times closed higher in the previous day. So take a look between January 1953 and December 1981. So the mid-month is right there, that arrow. But the beginning of the month and the end of the month, look at that. Look at how much trading volume is going on and what's happening. And you can take a look again. This is another chart here that's a little bit different. It's with the S&P. And they talk about different studies for the Dow Jones and some other studies. And these are things that are interesting in terms of just looking at it in behavior of psychology or market behavior. Now, really, if you understand this concept, you're looking at it and you're stepping back and saying, whoa, okay, things maybe are not going to be as good as they really seem because it's the end of the month. So take a chill pill. take a step back, be patient, relax for a moment, right? So you have to look at the market as a whole, but then also look at your individual positions. But understanding this, the way that markets move and behave, is just something that allows you to see things in a better form, in a better picture. It's kind of like if you're colorblind, you're only able to see a picture one way with black and white, right? But if you can see colors and you can see the different shades, it allows you to really digest many more forms of color. So think of it that way if that helps. But really, when it comes down to it, looking at the end of that month, remember that it's mostly window dressing. And by that, a lot of it is fake. It's a facade. They want to show you positions that they are going to have for their customers. That's not to say that you can't trade the stock. So if you're wondering, okay, can I trade Netflix because it's the end of the month? Of course you can. Of course you can. Just be mindful that it's the end of the month and you may want to sell some shares into strength, and be mindful that, okay, things may pull back or things may idle or consolidate sideways, and then, mid-month and things like that. But otherwise, take a look at the stocks and start applying these monthly trading patterns. And what do they tell you? What does it say about the stock? How is it moving? And it's the same thing when you apply it to earnings. When big events come out, earnings trade with a lot of volume. So take a look at this bar right there, or this bar right there. There's earnings move those stocks. And the end of the month, the same thing. The hedge funds move the stocks because they need to show their clients, their investors, a nice result or a nice portfolio or what they're doing. So keep that in mind when trading. Look at stocks, the way that they're behaving. Take a look at the end of the month, how things are moving, and just keep an eye out for all those different trades, how they're moving, how they're acting, how they're behaving. And that way you can be on the tip of your toes watching and saying, hey, okay, I'm not going to buy into this because I know the move may not be real. Or, hey, this move looks great, but I'm going to be more cautious about it. All right, so there you go. Thanks for joining me in this lesson, and I hope you got a lot out of it in terms of window dressing, about how stocks move towards the end of the month and the beginning of the month, because they do trade a little bit differently, and those are some of the reasons behind it. So be mindful, but there's not much you can do about it. You want to be a little more cautious about the stocks that you're in, or the stocks that you're trading, or the risk that's involved within your trades, or the things that you're involved in. And that is because if you're in the right trade and it's the end of the month, then maybe your stocks will pop. On the other hand, if you're in the right trade at the beginning of the month, again, your stocks may pop if you're in the right trade, and vice versa. If you're in the wrong trades at the end or the beginning of the month, again, they may move in the opposite direction, but then they may reverse. So be mindful of what type of trades you're putting on, because towards that end of the month, a lot of it is just simply window dressing. Now, I do want to, again, thank you so much for joining me week after week, especially for those of you that continue to watch every single recap that I put out. I get some great emails from all of you saying, hey, I watch every single recap. And again, I just want to truly thank all of you for joining me, sticking with me, because to me, that's really a great benefit, especially if something that I discuss, mention, or teach you, if you go ahead and use that in the future to prosper, to become more successful, then I feel that a piece of me continues to live on almost indefinitely, because it moves on with you through time. So again, thank you for joining me. Remember, do what you love, contribute to others, but most importantly, live life abundantly. And for us, we'll be in Canada the next couple of weeks, and then we'll actually be in Belgium. So that's what we'll be doing on our vacation time. And we'll still continue to output the critical charts, the rapid recaps, all during that time. But I'll keep you updated as things move along. So the schedule or anything else really won't change. So thanks again, and I'll see you next time.